bearish now for about 2 days, and it's going flippin' fantastic, right? I mean, yesterday we closed on the lows, and then today we're up like twice as much as we were down, so it's going just flippin' terrific. Look, just like when you see in a bull market, the market sell off on some days and then rally back, when you're going the other way, you're gonna see the market bounce up on certain days and then head back down.
Look.
The reality is that the impetus is for this market to go down. But while we haven't done terrible damage to the long-term trend, that meaning that the support level of 1284 is actually still intact. And if we had Carter Worth here in the office, well, we don't have enough money for that. But if we did, he would tell us that the bull market is still intact. But here's what I know. In the absence of any good data, although we actually got some good data today, which is why the market's up, so the media says, the market is going to continue downwards until we see earnings, which is in about 5 weeks. So I don't want to watch 5 weeks of this if I can just simply sit it out. And so the reality is, while you might feel like you're missing the up rally, it's better to just simply wait until July, about the 11th, when Bank of America reports, which has been sold off endlessly. That's another trade. So today we're taking a look at Concho Resources, ticker symbol CXO. This is an oil and gas play, and so you might think with the rising oil and gas prices, this company is your ticket to the profit train. But here's the problem. We did a little digging, and it turns out that the company might not be as well off as we thought that they were.
For instance,
the company trades with a PE of 48, which sounds terrible. Except for the fact that the forward PE is 15. Their margins are in the mid-teens. Not so bad, right? But here's the catch. $1 million in cash, $1.9 billion in debt. How in the heck does a company get that much debt and that little cash? Here's the other thing I know. They ate through about close to $2 billion in cash on the quarter. That's a bad thing. So we look back, and the company's actually been profitable since before 2009. So how do they get so much leverage, so much debt, and still be profitable? In fact, earnings were down from the March quarter year on year from 76 cents in 2010 to about 42 cents in 2011. That is an absolutely massive decline in EPS year over year on the quarter. Here's the other thing that I know. I'll tell you why March the 23rd is important in just a sec. On March the 6th, they came out with their quarter, right, the earnings for the March quarter, and they told us that the company paid off $13.1 million in debt. Wow, that sounds terrific, right? Except for the fact that they owe $1.9 billion, and all they really did was pay off $0.13 billion in debt, which is not a lot compared to how much they owe. Here's the other thing that I know. 17 days later, on March the 23rd, yeah, a 10K comes out. An 8K filing from the SEC comes out and tells you that they issued $600 million in new notes. So essentially the company paid off $13 million in debt and then went out and issued $600 million in new debt. I don't know about you, but it sounds like bad math. So here's what I know. The company's earnings have been going down. The stock is basically a high beta play on the S&P 500. So whatever the market does, it does, but more. So the market's up year to date. It's been up more to date. The market is down. This stock has been down more since the slide started around, say, March. So here's what I know. You can take a look at the 85-80 put spread going out to July and pay about $1.30, $1.35. Or if you really want to get bearish on this thing, you can take a look at Leap Options, 2012, 2013, buy some puts, and then sit around and wait for your story to play out. The other thing that you could do is bet that the quarter, which is on August the 2nd, is terrible, and that we find out that their current quarter is as bad as their last quarter, and then you can just be long a naked put and hope that it goes in your direction. You can try out of the money and take your profits quick, or you can try in the money and hope that it becomes more in the money. Either way, it depends on how you trade. How you trade is up to you. So make the bet that you feel comfortable with. And again, remember, these are just ideas. Now, the other thing that's really important to keep in mind is that they actually sold assets on the previous quarter. Now, what did they sell? Yes, that's right. None other than the hottest place to be in the United States right now, the Bakken Shale, and the Permian Basin. So wait a sec, they sold the Bakken, they sold the Permian Basin, earnings are declining year over year on the quarter. Here's the best part of it. They took a $283 million loss on derivatives that was not from hedging. So you have an absolutely crazy trading desk losing money faster than, say, that guy in Congress's picture of his woo getting shown on the internet. Okay, losing money on their derivatives desk, not due to hedging, selling off their assets, the good ones, levering up right after they told you that they took down their leverage. Look, we're not saying that we know exactly what's going to happen to this company, but I'm saying that CXO might be worth a look at for a bearish bet. Thanks for tuning in today at Lunch of the Market. Remember, sometimes the market goes up as well as the times that it goes down. We're waiting for it to go down some more, so even though it's up today, it could be down tomorrow. We shall see. But the safest bet is to wait till we get closer to earnings in July. But remember, if the earnings are bad in July, then we're going to go down even more. We don't think that that happens, but it's always a chance. So what we're going to do is get a little closer to earnings, see how the market trades, take our bets, and get a little hedge. Thanks for joining us again today on Lunch of the Market, and we will see you tomorrow.